Hey everyone, welcome. We just had the closing bell for Thursday, February 22nd, and it was a really big day. We had NVIDIA pull the entire markets up. Everyone got super enthusiastic, and we did get directional. So let's take a look at how everything turned out. Oh, before we do that, we can take a look. This was one example of a hedge that we put on together that we identified that we were going to take off by tomorrow. So we should take this off. And as you can see, we've lost about 86% on this hedge. That's okay because we sized this, or we made the assumption that we sized this to appropriate for our portfolio so that a $200 loss was not a big deal. And presumably your portfolio should have made a lot more than $200. So to give an example of that, let's take a look right here. So this was the March 1st 418 put. In a sample portfolio I have right here, we put on a March 8th for, what was it, 400 put. Okay, so this one was a little bit more aggressive. And you can see this one about 75%, which represented $143 loss. But the other positions in the portfolio, they made over $400 today. So that net, this portfolio is up $266. So that's what I mean when I say that your portfolio positions should be able to overcome any loss that you get from your hedge, and it should be able to overcome it by quite a large margin, which this one did. So this hedge for this portfolio was hedged appropriately. So on a day where we didn't end up needing that hedge, we lose a small amount relative to the amount that the portfolio gains. And you can see that that P&L just drastically changed. We were looking at 400 and then suddenly it became 300. That's because at the close of the market, some of these positions, their markets got marked super wide. So it's probably XLU or XLV. So if I look at XLU, you can see that this spread is a 10-cent spread on something that was worth 40 cents. That's 25% spread. That's really big. During the day, it was trading much more closely. And then, so maybe like a couple pennies apart. And if I look at XLV, you can see that this is a point, this is the one that probably did it. 75-cent, $4 spread. That's huge. That's a huge spread. And during the day, it was only trading maybe a 10-cent spread. So we happened to catch live on the video the precise moment where this market maker, after hours, took his spreads and made them super wide. So the real P&L was the first one that we saw, or the one that we should mark to is the first one that we saw, which was $400 up on these four positions right there. So we're not going to get deceived or freaked out by that change right there. So, but even if it was $300, then relative to it, we made twice as much as we lost on the hedge. That's still pretty good. That's still okay. Normally I would want a larger margin, like that 400 to 150 was okay. But we saw that mark get changed live, but that's just a movement of the spread, which when we open tomorrow morning, then it'll tighten back up. So our hedge served its purpose. It was there to protect us in the less likely event, or which was the breaking of the trend line. And we did not get the breaking of the trend line. So we expected to lose money on our hedge in that situation. And so we'll go ahead and just close this. We don't need this hedge anymore. So we'll just say, how do I close the position on option strat? Close my trades, save trades. Close this one, close it. Okay, so we'll just close that trade. So if you have any hedges on still for tomorrow, unless it was designed to protect you for a lot more time, I would go ahead and take that hedge off. It may still be appropriate to put on a hedge. We'll see in just a moment. Let's take a look. It's this one. How the markets moved today. You can see that we got pretty directional. For the first half, we were mostly flat. That's not surprising at all. And right around 9 o'clock, maybe 9:30, 9 o'clock, we started to get really directional not in NVIDIA, that just stayed flat all day, but we can really see it's a little bit more obvious in Apple and in Amazon, where we really start to get directional. And in the S&P, it's not as obvious as starting point, but it's probably right around here, 9:30, where we really started to get directional. We pulled back a little bit, and then we recovered a little and then chopped sideways into the close. So not a lot of bull and bear traps, like I was saying this morning, but we did get sideways movement for most of the day. And then we got directional towards the end of the day, which we just got directional a couple hours or hour or so earlier than I believed we would. So this market was really, really strong today and a lot of enthusiasm. So does that change our view on a daily basis? We need to take a look at S&P 500. We moved well above those highs, the previous high. We made a new all-time high today, and we are closed at 503 and a half, or 507 and a half. Our high of the day was 508 and a half, which puts us within reach of that second psychological resistance right here, the 25% move. It's conceivable we could touch that tomorrow or early next week. And we'll see how strong of a resistance that proves to be. And if we start pulling back from that point, our next test of this trend line over here, either the EMA 20 or the trend line, will be the highest potential that we've had so far for breaking that trend line and staying down, actually changing the trend. So, and getting at least a 5% pullback. So we'll want to watch that very carefully. For now, we can remain bullish. We've got a little bit of room before we hit that psychological resistance. That psychological resistance may turn out to be vapor, not even anything, because there's no actual price structure to ever in the past to have supported it. So we could just slip right through it without a problem, but we'll see, because in the recent history, we've seen that the market makers were able to withstand up to a 30% move. So we could go another 5% conceivably. We could keep on bouncing, go 5%, and then we really would expect a pullback or a correction. But we'll see how that develops. If we actually do make it 30%, I would be more likely to presume that we would get a correction and not just a pullback. If we pull back from the 25%, I would give it 50-50. Either a 5% pullback or the 10% correction. So in any case, right now we're looking very strong, and we're very glad that we kept our portfolios pointed up positively. We didn't get freaked out. We didn't get freaked out by all this noise of people saying that it's overbought and it's overbought and it's overbought and let's short it. No, we don't jump the gun. We hedge ourselves in case we're wrong, but we just keep on going with that trend. We go QQQ, huge jump upwards, and also matching the previous all-time high today and then pulling back a little bit. So that is really, really strong. What we need to see from the QQQ, however, is continued strength and to get beyond this all-time high that we have right here. Otherwise, we're just chopping sideways into that wedge, and we'll have to either break down or break above that all-time high. So we'll see if tomorrow brings enough strength for us to move comfortably above that all-time high that we see right here. Diamonds. Diamonds all-time high today, not as pronounced as the S&P 500. And so this one could conceivably go a little bit longer than the S&P 500. It could continue a little bit longer. The other possibility that I've just noticed is that we could go parabolic. If people are super enthusiastic about this, because that's a huge gap up right here. If people get over exuberant and we start doing this, then that would be almost for sure 99% chance that it's over. We would reach a high and then we'd start pulling back, at least to that MA50 right there. So we'll see. We need a couple of days to figure out if it's actually parabolic or not. But for now, we're just going to watch and wait. Keep our portfolios pointed to the positive side. The reason why I said if you have a longer term hedge, you may just opt to keep it on since you sized it to an acceptable loss anyways. Even if it goes down to zero, you'd still be okay and absorb that loss in your portfolio because we could pull back from here. We did in this S&P 500, we did just make an all-time high. And what happened when we made this all-time high? We pulled back pretty strongly the next day. What happened when the previous all-time high was probably right here, and then we exceeded it, and then we chopped sideways for a little bit before continuing upwards. So when we have huge gap ups like this, it is appropriate and expected that we'll either consolidate or we'll pull back a little bit from it. So your hedge, as long as you have enough time value left in it and you don't get hurt by this 1 day of time decay, you could hang on to it for most of the session tomorrow and just close it at the close in case we get this pullback. But that's kind of nitpicking. It's not really that movement in terms of the S&P 500. It's just 1 day's movement. It's not going to, unless you sized it weird, it's not going to make a huge difference in the end loss on that hedge. So it's just really nitpicking, and out of convenience, I would just close it. You don't need that hedge at this particular moment in time, and allow your portfolio to grow unhindered if this market continues to move upwards. And then if we touch that line again, that trend line again, then we can start thinking about putting on hedges once again. One thing that is going to be really interesting, well, actually, let's take a look at TLT. Let's take a look at VIX. Let's take a look at CPC. And then I want to see how small caps are performing. I want to see how they're doing in light of all of this. So let's look at VIX. VIX came way down. So gap back down to, we're still in a somewhat elevated range right here, 14.5. Considering that just a week ago we were in the 12s. So this could go down a little bit more, but at my VIX, any VIX hedge, I would take that off as well at this point in time. And then CPC, so this 0.75 level was a good call, or just bounced right back up the last 2 days. Now we're approaching extreme levels to the put side where it's looking like, to the call side, where we're getting a little too enthusiastic on the calls. So with it being an all-time high, that's not too surprising because like I said, when we make an all-time high, the tendency is to consolidate or pull back a little bit before we can resume even higher. So it's not surprising that we're indicating on the CPC that we can expect that we have too many calls relative to puts, I should say. So TLT just continues to chop sideways. So this morning I was talking about how we broke below that MA90, but not the MA100. So we would want to see if we broke below further down, and that would be a lot of downward momentum or downward force on the markets, but we just chopped sideways instead. So nothing exciting in the treasury sector today. And then what was I going to look at? Small caps. We're back to this pink line right here. We want to break out with conviction. Looks like we bounced off of the MA50. We got a pretty good bar today, so we want this to continue, and we want to break out above this high right here before we start to get really interested in the small caps. We did, yeah. And let's take a look at ARK. It's really unfortunate for ARK and Cathie Wood because she has been saying that there's going to be an AI revolution, and obviously her ARK fund was not able to capture it at all over the last year when NVIDIA and all these AI stocks started to go up like crazy. Her fund that was supposed to take advantage of exactly this sector just went sideways. So what we want to see is more strength in the ARK fund, because these are small cap, higher risk, but high growth, like extremely high growth potential stocks. So once the market has an appetite for these types of stocks, then we can know that it's really in bullish mode. For now, if we are avoiding these stocks and we're just in large caps, then we're still seeking, to a certain degree, we're still seeking some safety, just not so safe that we're completely piled into consumer staples or other defensive sectors, or that we are moving money out of the equities markets and into things like bonds or crypto or something else that's perceived to be safer at the moment. Not that crypto anytime soon could be considered safe compared to equities, but it's what we're seeing over the last few years is where in the past, we would have expected money to leave the market and go into gold or other commodities. They're going into cryptos instead. So they are acting like a flight to safety asset, even though they're an extremely volatile asset and there's no safety afforded there anyway. So, and that's mostly retail guys, because most institutions are not able to trade the Bitcoin directly. And so that's why there was that big movement and announcement that several Bitcoin ETFs are going to start, or they were just approved. So once those get going, then the Bitcoin or the crypto market is a little bit more accessible to these large institutions who might want to use it to hedge. That'll change the behavior of the crypto markets quite a bit. All of the what everyone's touting as quote unquote freedom or breaking away from institutions or oversight and governance, that's all going to go away once institutions come in, because you can bet that the SEC and the government is going to start regulating those markets. And once that happens, a lot of that volatility is going to be removed from those markets, and the days of high flying cryptos are going to be over. So enjoy it while you can if you're trading cryptos. It's going to end pretty soon. Once we get these ETFs and we get large money from institutions coming in, then those days are going to be over, and you're going to see institutional influence. You're going to start seeing it behave a lot more like equity markets, because the institutions with their massive amounts of money are going to be controlling those markets as well. So ARK, not quite there yet. We need it to move. It's even weaker than IWM. We really need it to move upwards. When we see that happen, then we can start paying attention to small cap stocks. And then when we see that happen in small cap stocks and we get alignment in the major indices, meaning that they've finished their pullback or they've finished their correction and they're moving upwards, then we have super speculative stocks leading. Then we've got speculative stocks leading next. Then we've got high growth stocks, large cap stocks leading from the QQQ. And then we've got all of our kind of mid-road kind of safe sectors like healthcare. And then we've got the ones that are just, that people just hate to put their money in when the market is screaming higher. For example, consumer staples or utilities. When we have that stack in our sectors, then we will be in a true bull market. We're not in a true bull market yet. We are in an uptrend for sure. We're just not in a true bull market quite yet. So we'll be watching out for all of those things tomorrow. End of the week, let's see how volume was. Yeah, volume all week has been more muted. We probably will exceed the average today. And then tomorrow, rounding out the week, nothing special is really happening in terms of expirations. Nothing happening in the earnings markets. That's mostly going to be mid-cap stocks until we fade away for this particular earnings season. So not a lot of stimulants in this market. So we're either going to ride the euphoria from NVIDIA earnings into tomorrow, or we'll just start pulling back and maybe pull back a little or trade sideways. So no way to know for sure. We'll just have to wait and see how that all plays out. Okay, so that's going to be it for today. Hopefully we're learning a lot. We're learning the value of hedging and not trying to front run or guess where the market is going to go and just hedge when we think that there could be a change. So we'll leave it there, and I will see you guys tomorrow morning. Have a wonderful rest of your days.